in today's market, what we've seen is inventory is at an all-time low. We've also seen interest rates double over the last 12 to 15 months. And these high interest rates are wrecking the performance, and it's making it really hard to find deals. And so structuring your deal in the right way, whether it's a single family fix and flip, whether it's a BRRRR property, a 1031 exchange, a development site, the structure is becoming so important to get your next deal done. Time can kill a deal, right? As you purchase these properties, you take them down with hard money, there's a lot of debt cost that adds up in those deals, just by even waiting for permits or getting the renovation going. So by avoiding that expensive money and offering different terms, you can still get a great buy as long as you do things a little bit different. What's going on, guys? It's James Dainard, and we are back on BiggerPockets YouTube channel. Today, we're going to talk about structuring your next deal and why structure can be as important, if not more important, than the purchase price that you're paying. At some point, you probably consider buying gold or silver as an inflation hedge or to add some stability in your portfolio. But unlike rentals, metals don't make you any passive income. Until now. With monetary metals, you can own gold and silver while earning up to 5% a year on it, and it's paid in ounces, not dollars. First, open an account with monetary metals. Next, choose what qualified business you want to lease your metal to, then earn some passive income. And if you're a accredited investor, you can even earn double-digit returns in their bond opportunities. Don't let inflation and high interest rates erode your hard-earned wealth. Diversify your holdings and earn an inflation-proof income with monetary metals. A yield on gold paid in gold. So head over to monetary-metals.com/big for an exclusive offer for BiggerPockets listeners. So right now I'm outside of a duplex in Bellevue, Washington that I'm currently doing a 1031 exchange on. I close on it in about 2 weeks. My original offer was about $1 million on this property, and I actually paid $100,000 more for this property. Having the same financial results, I'm getting the same return, and I'm actually having a little bit better cash on cash return because I put the right structure together. So let's talk about that. So traditional ways of buying your fixer property below market value are having problems working. The reason being is with the cost of money, even with hard money going from 10% to 12%, and then you add that up over a 6 to 12 month period of time, when you're dealing with more expensive properties, especially in metro markets, that can add thousands and thousands and thousands of dollars to your cost, which are going to erode from your loan to value, it's going to erode from your profit, and it's also going to add more cost to the deal, which is going to require more financing and also kill your cash flow. So the debt cost is becoming a major problem. That's why it's essential for investors as they find good potential investments to figure out how to make it work with the seller and inside of your pro forma. So looking for ways to avoid that expensive hard money cost to get into your next deal can really make or break your deal. So let's look at this example right now. So like I referenced, I'm buying this duplex on a 1031 exchange. Currently, I'm in contract on this building for $1.125 million. That seems expensive for a fixer, but it was a really good buy. Prior to rates going sky high and doubling, this property was worth $1.75 to $1.8 million. So that is a huge equity potential in the building. The property needed about $175,000 to get it fully turned and to get highest and best use out of the rents. Inside that renovation, we were changing out the windows, we were replacing the roof, we're doing all the flooring, cabinets, bathrooms are getting retiled, all new surrounds. It's getting a full turn, but that's going to get me the highest possible rents. The property was in terrible shape when I bought it. It was going to require a cash close. It was full of chickens, it was full of cats, it was full of rats, it was stacked to the ceiling with hoarder gear, and the roof was leaking everywhere. A bank is not going to want to traditionally finance that. That's why investors either have to pay cash, which I would have to come up with $1.15 million to close on this, not going to happen, or I was going to have to take it down with hard money, and like we referenced, that is an expensive cost. That deal wasn't going to work for me, so let me explain why. If I paid $1.2 million for it and I had to put $175,000 in, that was going to be a basis of $1.375 for this property. If I used my hard money lender Intrust Funding out of Bellevue, Washington, they were going to charge me 2 points and 12% for a construction loan. I was going to have to bring in $350,000 down as the down payment to meet their loan to value, and they were going to finance me back the $175,000. But during that time, with what the seller wanted, I was going to have to close on the property, pay the hard money cost for 2 2 months as they pack up their things and move out. Then I was gonna have to vacate the property, renovate it, get it appraised, and then refinanced, which was gonna have me sitting in the hard money cost for over 8 months. And at 12% in 2 points, that was gonna equate out to about $80,000 to $85,000 in cost that was gonna dramatically affect the deal. Because then at that point, I was paying 1.2 for the purchase, 175 for the renovation, that's 3.75, plus another 85,000. I was gonna be into this property for basically the market value. There's no point in buying a property, moving out people, doing all the hard work to make no equity gain. That's not a smart move. It would make more sense for me just to go buy something that's already in better shape on market with stabilized financing. But the issue I was having was there's not a lot of product like this in the market, and it's what I wanted. So I had to kind of educate the seller and talk to them about price. My first price was $1 million to them. I offered them $1 million and I was gonna close on it on time in less than 2 weeks, let them stay there for over 2 months, do the renovation, do my BRRRR, and get stabilized financing. So the problem was they weren't really coming down too much off the 1.2 million. The lowest they would go was 1.125. But again, we just talked about how those numbers wouldn't work. I don't want to do all the hard work without having an equity gain. That doesn't make a lot of sense. So then I started to try to think outside the box. How do I get them the terms that they want, which was the flexibility, a little bit of cash, get ready to move into a new property, and then how can I purchase this property without having to take it down with hard money and put the $8,500 to $100,000 in financing costs back into my pocket? So how did I bridge the gap between 1.2 and $1 million without affecting my return? So I wanted to look at what the full picture was. How do I solve their move out problem? How do I get it for the price that I wanted to be into it for? Because again, if I was offering $1 million on this property, it was gonna cost me roughly $85,000 to $100,000 in interest points and costs during that time. I really could go up to about $1.1 million with it being the same math. So what I did is I offered them a creative solution. I talked to the seller, I said, hey, look, here is the value of your property today. We looked at what needs to be done to the property and we took that off the price. We took the real estate commissions off the price and looked at what their net was. They could see that I was giving them a really good number at 1.125 million for what the current present day condition was. That's a really important thing you always want to educate sellers on. What is the as-is value, not what it was worth or what could it be worth. The potential value is done by the plan, which isn't done by the seller. That means it's the benefit to the investor. So we had a very clear conversation. We reviewed all the financials. After we reviewed that, they still weren't willing to go down to the $1 million, but then I proposed a solution that would work for them on all fronts. So I focused more on terms than price with them because I knew I wasn't getting down to my $1 million. So then I gave them a solution. How do I fix their move out? We put up a large amount of earnest money. I had $280,000 for my exchange coming over for this property. I was able to put up $100,000 in earnest money after I'd done all my feasibility, all of my inspection, and was good to close on the property. We then released it to the seller and gave them 45 days to move out during that time. So what that did is I didn't have to close on the property. They were able to obtain the money to pack up and get their new place and move out without stress. In addition to, I wasn't having to take the hard money loan down to start racking the interest. So once we solved their structured move out to where they got the money and they could move into a new property, which relieved them of the pressure, then we had to figure out how to get the rest of the financing cost down. Remember, I was gonna have to buy this with hard money because it wasn't not in financeable shape. I had to get it in financeable shape to avoid those costs. So inside of our contract, we worked out terms to where I would close 60 days after a move out. During that 60 days, the seller acknowledged it and gave me written approval to do whatever renovation I needed to do to get it in financing shape. Right now, we are inside of the property and we put all new flooring in, cabinets, we've spruced up the outside, we fixed the roof, and now we know that we can have the property appraised and financed. So now instead of having to take a hard money construction loan, I'm able to finance it with a straight conventional loan and reduce a ton of debt cost. In addition to, the day after I close, I can put it up for rent and fill this place immediately. Remember, going back to the value add, the BRRRR structure, I was gonna take it down with a hard money loan, renovate it. I was gonna have to pay the cost for 6 to 7 months of just holding the property, refinance it, and then rent it. So it worked out really well for me. I could avoid the $85,000 in hard money costs. And not only that, I'd have an asset I could rent the day after I funded. The structure though can be a little bit risky and you have to protect yourself with the right paperwork. So right now I'm putting in all new cabinets, all new flooring, we put in windows, we put in a roof, and I don't even own this property yet. That seems a little weird, right? So you have to do it in the right way. So in our contract, it gave me full access to the property. The seller gave me written approval to do whatever repairs I deem necessary during that 60-day period to get it financeable. They gave me 100% authority at that point. That's a good thing. You always want that written access at that. In the contract, it also stated that they are not allowed to come back and come into the property and interrupt this process at any time. So again, I have full open access to get it done inside that 60-day window. The next thing I need to do is prepare and protect my investment, right? I've given them $100,000. I released it to them so they can move on to the next project. And then I'm putting in about $150,000 into the property just to get it financeable. So that's $250,000 that I'm coming out of pocket with before I even own it. So what we do to protect ourselves is we file a memorandum of sale. It's filed against the title, it secures my interest in the property, and it clouds the title to where nothing else can happen. It can't be sold, no title insurance is going to insure it, and it protects the investment. At the same time too, as you're working out these agreements, you want to just make sure that everybody's on the same page. They know exactly what I'm doing. They want to get this property sold. After all, I explained to them why my offer at 1.125 was a great deal for them. They know they're getting paid the highest offer, so they're a lot more flexible with me. So during this process, we're constantly updating them, we're talking to them. In additional, we add ourselves on as additionally insured on the insurance policy because we want to make sure that everything we're doing is insured and the seller is covered as well. So this was a win-win structure for me and the seller. The seller got their high price they wanted, and it made my investment overall better, even though I'm paying $100,000 more for the property. When I first was going to buy the property with a construction loan, I was going to have to put down $350,000. I was going to have to carry the debt cost of around $10,000 a month for the next 7 to 8 months. That's $80,000, and eat the points. That's $100,000. But by doing this structure, I came up with $100,000 for earnest money. I came up with another $150,000 in renovation cost, and I'm only out of pocket $250,000 rather than $350,000, and I'm saving on all the debt cost. It was a win-win. I made $100,000 more in equity, and I had to come up with $100,000 less to buy the property. So as debt becomes more and more expensive nationwide, and it could be here for the next 6 to 12 months, as investors, it's our job to stick and move. You have to structure your deals a little bit differently. If I would have stuck to my $1 million offer and was refusing to budge, I would have never got this deal. And there's a ton of potential here. In the next 2 years, I plan on selling it for about 1.8 to 1.9 million. That would have been a loss of $250,000 down the road if I would have just kept my blinders on and done with my traditional structure. So always look at how to merge the two parties. How can you get the seller what they want and also get you the math that you need? A lot of times it comes down to structure, not price. Explore different options. What will work for that seller? What helps them move in that direction? And how can you reduce your core cost? As inflation goes up, as financing goes up, it's our jobs to battle those back, whether it's construction or financing. The more creative you are, the more you'll be able to revolutionize this market. Thanks for watching our video on creative financing. And if you liked it, make sure you like and subscribe below. And for any more questions on creative financing or how to structure your next deal, put your message in the comments. I will make sure I respond. I'm James Dainard on the BiggerPockets YouTube channel, and I will see you guys again.